The Intelligent Investor by Benjamin Graham. Greetings, in this video we've summarized 8 principles for individuals who don't have time to read the book. The book Intelligent Investor covers how to engage in value investing and stop Mr. Market from influencing your financial decisions. Before diving into the video straightway, don't forget to like this video and subscribe to our YouTube channel. We all understand how vital money is. However, not everyone is necessarily an expert on it. In this brief overview, we'll discuss some sobering financial realities and show you how to succeed financially in life. You can learn the secret to effective budgeting, saving, and investing by investigating some of the author's thoughts on personal finance. From here, your financial situation can only get better. Here are some important takeaways. So, let's get started. Number 7. The safety margin. The fundamental principle of value investing is to purchase assets at a discount to their intrinsic value, and hold them until their price reaches their inherent worth, generating a return on the investment. Graham declared that his objective was to purchase assets worth $1 for only 50 cents, and he successfully did that. He could accomplish this in one of 2 ways. Utilizing market psychology was the initial strategy. In other words, he took advantage of the market's fear and greed. Number 6. Investing is neither speculating nor gambling. Graham's Mr. Market was a brilliant analogy that he used to explain the market. According to Graham, an investment should guarantee the return of the money invested and provide a profit that is more than the inflation rate. Unfortunately, Mr. Market is a bit of a manic-depressive character who occasionally offers wildly enthusiastic or even absurd prices. Number 5. Avoid falling for the hype. Many individuals mistakenly believe to be a sure thing may result from their insanity. Take the dot-com bubble of 2000 as an example. Because of the rapid growth of technology, everyone wanted to invest in it. Since prices can't rise indefinitely, many investors lose more than half of their portfolios. On Wall Street, there will always be a hot new formula that appears to work for a while before disappearing just as swiftly as it appeared. The savvy investor would not fall victim to this folly and make sound decisions instead of speculative ones. Although it may seem difficult, employing sustainable methods that have been proven to work ultimately leads to success. Number 3. Intrinsic value is important. Knowing your target value might help you determine whether or not your investment is a worthwhile one. Graham reveals that surprisingly few individuals do this. They instead employ more speculative techniques to determine when to purchase and sell a stock. For instance, many buy stocks purely because they rise or sell them because they fall. Number 4. Reducing risk to the downside. Graham frequently emphasized the significance of purchasing investments with a margin of safety and doing so below actual, or intrinsic value. This is significant because it enables upside profit when the asset eventually revalues to fair value on the market. However, if things don't go as expected and the market declines, the margin of safety strategy also offers some protection on the downside. Graham would consider a company's liquidation value when valuing its shares. For instance, real estate investors may take land value into account to reduce downside risk. Number 2. See beyond the horizon. As for Graham, the market is a weighing machine in the long run, a voting machine in the short run. There will always be Chicken Littles there to warn you that the world is ending and that now is a bad investment time. We cannot predict what the markets will do in the near future. The market will eventually return to its mean value and represent intrinsic value, albeit in the long run. Buy and hold onto assets in high demand for the foreseeable future. That can be summed up as wise investing. Number 1. Mr. Market. In Benjamin Graham's The Intelligent Investor, he argues that market prices are useless because they frequently undervalue businesses. Instead, he takes advantage of these inefficiencies and sets his own prices rather than letting them dictate his course of action. Since it gave me a fresh perspective on markets, this is perhaps my favorite section of the book. Last but not least, avoid getting sucked into Mr. Market's mood swings. The market is insane now, but everything will work itself out in the long run. Because of this, you have faith and decide not to sell when equities are particularly undervalued. This concludes our video. Are you following any of these principles? Please share your thoughts in the comment section. Don't forget to like and subscribe to our channel. We'll see you in the next video.